Sydney, Reuters. Asian share markets were set for a rough ride on Monday as fears of resurgent inflation battered bonds, toppled Wall Street from record highs and sparked speculation central banks globally might be forced to tighten more aggressively. Futures for the Nikkei and KC1 implied an opening loss of around 1.6%, while Australia Euro trademark S main index was already down 1.4%. E-mini futures for the S&P 500 ESC1 shed 0.5% in early trading, an unusually sharp move for Asian hours. Investors were spooked by Friday Euro trademark S US payrolls report, which showed wages growing at their fastest pace in more than 8.5 years and fueling inflation expectations. USIL 5Y F5Y equals R. Futures markets zero number FF reacted by pricing in the risk of 3, or even more, rate rises from the Federal Reserve this year. A Euro or ETH earnings data fits too closely with the narrative of emerging wage pressures to be dismissed, a Euro, said Deutsche Bank macro strategist Alan Ruskin. A Euro or ETH data will add fuel to the debate on whether the Fed is falling behind the curve. It will raise the chances of the Fed median dots shifting up to 4 rate hikes for 2018, a Euro, he added. That would be negative for emerging markets and commodity currencies, said Ruskin. Both the Australian and New Zealand dollars fell sharply in the wake of the jobs numbers, along with a range of Asian currencies. It was also a major blow to government bond yields on 10-year U.S. Treasury paper. US 10 YT equals RR were up at a 4-year peak of 2.852%, having jumped almost 7 basis points on Friday. The 2-year yield US 2 YT equals RR was near a 9-year top at 2.153%, tightening financial conditions and offering a more competitive return compared to equities. Dollar off the mat. Wall Street had already been flashing expensive on many historical measures and sold off in reaction. The Dow.DJI fell 2.54%, the S&P 500.SPX 2.12% and the Nasdaq.IXIC 1.96%. It was the Dow Euro trademark S biggest daily percentage loss in 20 months and the largest point fall since December 2008. The three major indexes logged their biggest weekly losses in 2 years, after closing at record highs the previous week. Yet the lift in U.S. yields came as a relief to the dollar after a rocky start to the year. A Euro or ETH dollar. A Euro trademark S steep rise aligns neatly with the bounce in U.S. bond yields and a degree of safe haven demand on equity weakness, a Euro, said Sean Callow, a strategist at Westpac. A Euro or ETH suggests that perhaps the tortured explanations around year-end of why the dollar was not benefiting from the Fed Euro trademark S tightening cycle can be shelved, at least near-term. A Euro. Against a basket of currencies, the dollar was up at 89.195.DXY, having climbed 0.6% on Friday for its biggest single-day gain in 3 months. The dollar was hovering at 110.16 yen JPY equals after bouncing from 109.29 on Friday, while the euro had eased back to $1.2427 euro equals from a top of 1.2518. The rally was a negative for commodities priced in dollars, with the Thomson Reuters CRB index.TRC CRB down 0.5%. Gold XAU equals was off at $1,330.86 an ounce after losing 1% on Friday. In oil markets, U.S. crude CLC1 fell 48 cents to $64.97 a barrel, while Brent LCOC1 lost 49 cents to $68.09. O/R